Mind Shift to Millions.
Mind Shift to Millions, and she's one of them. She can explain things so easily, like no one I know. So I love talking to her. She knows everything about finance. It's crazy. So also, if you have any questions, please fire away right after her presentation. So here's Lauren.
Hi. Well, today I'm going to be talking about, I don't know how many of you were at the last one in January? Okay, so a number of you. Okay, great. I didn't repeat myself much in this, so it won't be too much for you. But today I'm going to talk about the pitfalls of real estate investing. It's a different world than the public equity markets, which most of us are very, very familiar with. So I want to get into how we can avoid making mistakes. So before I get into it, I just wanted to know if anyone's felt the bite of inflation recently. Because I saw this recently, it's astronomical, and anyone who's made an insurance payment recently, anyone who has children and tries to, I don't know, put them in an activity, it's a joke. And unfortunately, inflation's not going anywhere. We all know what's happening in this country now. We'd be lucky if 2 to 3% is what we see each year in terms of the inflation rate. So it's extremely important that everyone, I'm so happy you're all in this room, it's extremely important, I believe more important than ever for us to be financially educated and knowledgeable about what we're doing with our money. Because if there's $14 eggs coming, God knows in 20 years what they're going to cost, okay? So, a lot of us feel like we're on a financial treadmill. Even if we feel like we are moving forward, and okay, you get your 5% raise, and then everything goes up 3% in cost. So it's a lot of us feel like at times we're moving forward, but maybe not as quickly as we thought. And just to give you some background on myself, my husband and I several years ago had this conversation where things were good. We felt like, okay, we're moving forward, but could we be swinging the bat harder? Is there more we could be doing? We're paying a lot in taxes. I live in California. You guys live in New York. We're paying a lot in taxes. Is there anything we could be doing? And so we really started to ask those questions. And it felt like despite the fact that things were going well, we weren't getting ahead as much as we thought we could be. And so that's really what led us. At the time, we were very focused on our retirement accounts and our brokerage accounts. Essentially, what wasn't going into retirement accounts were going in the S&P, and we were taught, okay, in 40 years it will be fine. So, and in the meantime, we'll just keep grinding away and working. And that's very much what the plan was until I got into real estate. And for those of you that don't know, there's a lot of predictions on this, but Goldman Sachs has predicted that the S&P will grow 3% annually over the next decade, that the growth that we've seen over the past decade will not sustain. And so for anyone who's not sure or didn't know this, 13% annual has been the average in the past decade annual rate of return in the S&P. So we're looking at the next decade going forward is going to look very different than the previous decade has. So this whole notion of, okay, it's going to be fine, we'll just go ahead and put our money in retirement accounts and we'll throw the rest in the S&P and it's going to be fine. Well, if Goldman Sachs is right and the S&P is barely keeping up with inflation, there's got to be more that you think about in terms of what you're doing with your money, because you're going to be running in place if this is your plan. And many people have asked, why is the S&P projected to be so sluggish over the next 10 years? And that's because in 2024, over half of the returns on the S&P came from 7 companies. They're dubbed as the Magnificent Seven. So they're coming from this. So over half, over 50%, 53.7% of the S&P return over the past 10 years, in 2024, came from these 7 companies. And the thought is they're going to have a hard time continuing to grow at the same rate. And if over half the return is coming from them now, will they be able to sustain that growth over the next 10 years? And the general thought is probably not. So that's why, and the general consensus is that the S&P will be more sluggish over the next 10 years. It's, different entities have different thoughts on it. But the point is, you say, okay, great, now where do I put my money? That's what I thought. And, I've got money in almost all of these, and I'm sure many of you have considered these types of investments. I think we're standing in this room because the majority of us got to real estate, or at least we think we want to get into real estate. Now, we're at different levels in this room, but I really want everyone to know that I started with one rental that I just turned into a rental when I got married. I had owned it, and then I was like, okay, it's a rental, and then bought a few single family out of state, and then I made a few passive investments, and it really has been, now it's quite a snowball and moving pretty quickly, but really when I started, I don't want anyone to feel intimidated by the fact that you can start with one property, one passive investment, whatever it is that makes you feel comfortable. But I'm here today to help you avoid making some of the mistakes. The reality of real estate is that you aren't as protected as you are in the public equities, right? Public equities, the stock market, they are highly regulated. They're publicly traded companies. All the financials are there before you invest. There's a lot more information on those investments, and they're also liquidatable like that, right? If you don't like it, you can get out tomorrow. Real estate's a very different beast. You have to be more knowledgeable when buying a piece of real estate, that if you want to do it well, than when you buy a stock, a publicly traded stock. So that said, why real estate? Why are we looking into real estate? Why are we sitting in this room today? Passive income. Passive income is a huge reason why a lot of people get into real estate. But more importantly, in my opinion, is the tax advantage passive income. I talk to investors all day long, every day. And many of them say, well, 10% on real estate, I mean, I could earn 10% on my stock portfolio. I don't need it. It's different. Passive income from real estate is taxed, well, with depreciation is oftentimes not taxed. So you're talking about returns on your investment that are not taxed as compared to your stock portfolio, that if you sell your stocks, you're going to pay capital gains. If you're getting a dividend, you're going to pay ordinary income. It's taxed completely differently than your real estate. So when you think about real estate, it's not apples to apples. So never take your returns on, let's say, a stock portfolio, compare them to real estate, and assume you're comparing apples to apples. Very, very different. So another piece of the returns that you're going to see is principal pay down on real estate. I'm talking about long-term real estate here, long-term holds, but your tenant is paying down your mortgage every month. So not only are you getting passive income from there, they're also paying down the principal on the loan. So that's another type of return that you're getting from your real estate. Then there's property value appreciation. If you're buying multifamily, you can impact this. If you're buying a single family, this is based on comparables. But generally speaking, single family homes have appreciated at 3% per year on average, forever. So if you buy a property and you hold it long enough, it will appreciate, and that is a level of your returns. And that you're at the same time you're getting your tax advantage passive income and your principal is being paid down, you're also getting property value appreciation. So again, you can't compare necessarily the apples to apples when you're comparing this to other types of investments. And then inflation-induced debt destruction. As we just talked about a second ago, the value of that dollar is going down every year. And so while your debt on a property may be a fixed amount, let's say you buy a property and you take a $200,000 loan out, that $200,000 loan, if you don't refinance, is going to sustain. And the value of that $200,000 is going to be eaten away by inflation. So that's another advantage to owning income property with debt. And then real estate professional status. Ted talked a lot about this in the last presentation. If you aren't familiar with it, please get familiar because it's absolutely incredible. And it has taken our tax rate down to single digits in California. So it's really significant to understand this. But the natural thought then is, okay, real estate sounds good. Thanks for telling me all the ways I can earn a return, but it's terrifying. You don't have the same protections as we talked about compared to the stock market. And there oftentimes isn't the same level of transparency. So it can be very scary. But I'm here today to help you avoid falling down the stairs and to help you. I'm going to talk about the most common pitfalls. There's all sorts of pitfalls, but I'm going to talk about the ones that I've seen the most, and honestly, some of the ones I've committed, I've done myself, and mistakes that I've made. So the first pitfall, is buying a property with negative cash flow. This drives me crazy. I know someone who inherited a lot of property in LA, and she's buying another property, and it's going to lose money, and she said, it's going to be okay. I'm like, no. Do you know who I am? It's not okay. But anyways, when you're buying a property that loses money, you're buying a liability. It's not an asset. And as long as you know that and you know that you're buying another obligation, okay, but the whole point of this is to buy assets that are going to pay you, not cost you. So very, very simple example. You buy this property for $500,000, you put a down payment of $100,000 down, the mortgage and the expenses are going to cost you $3,500, the rent is $3,000, so you're going to lose $500 a month on this property. And a lot of people will keep properties like this, even though they're losing $500 a month. And that's if nothing goes wrong at the property. I just replaced 2 air conditionings. That would eat away at this. I also had Hurricane Milton blow off the roof of one of my properties. That was a $5,000 deductible. So if you buy a property and you're already losing at the start, you are going to lose more than what you think you're going to lose. So if you buy a property in the onset with positive cash flow, please pay very close attention to that. Wrong debt. This is where a lot, oh yes?
Yeah, I had a quick question. If you go back to the previous slide, in New York, we have a lot of properties that really don't cash flow. So
Yeah.
when you have a duplex for $1 million,
Yes.
and each unit rents out for $2,200 a month, it's tough to make that cash flow. How do you play in appreciation into where kind of New York real estate is going to grow every year? Maybe that's your exit strategy.
Yeah, I don't like it. I don't invest that way because that's you're gambling. You're just assuming, and of course, New York real estate, LA real estate, it will go up, but you don't know how long that will take. You don't know what's going to happen, and the Pacific Palisades, which is I went to school right there. Those values were going up and up and up. I don't know if all of you remember the fires in January. I have a friend who lost her house. It was worth $4.5 million before. The land was worth $3 million, and now they can't sell it. So you just don't know. So to bank on appreciation, I think is gambling. So that's why. But I'm also not. I've probably told everyone in this room, don't buy real estate here long term. But the way that Erica's doing it, wherever she is, where it's a big heavy lift, that I can understand. That's because she can make the numbers work. You just need to be able to make the numbers work. So if you can't, I strongly suggest not buying something with negative cash flow, assuming it will appreciate. Because unless you plan on cashing out that appreciation someday, you don't really have any control of that.
Thank you.
Yeah. So wrong debt. This is where a lot of people got into trouble. A lot in 2020, 2021. A lot of big multifamily and commercial real estate operators got into trouble with getting the wrong debt. And what that means is getting variable rate debt in an uncertain interest rate environment. So in 2020, 2021, 22, when interest rates were 3% and 4%, a lot of operators were going out and getting variable rate debt with no rate cap, which means that the rate can't go up, more than a certain amount. And they were getting this variable rate debt, and they bought properties with 3% and 4% interest rates on shorter timelines. So here's an example. And again, this could happen at any size property, but we saw a lot of operators, commercial real estate operators, lose their shirts over this issue. You take out a loan for $5 million. In 2021, the interest rate was 3.7%, and on a 2-year bridge loan. And so the mortgage was $15,000 a month. Well, the 2-year bridge loan expired. Interest rates then were 6.8%. So the mortgage went from $15,000 to $28,000. And even if you've improved the property and improved the net operating income, a lot of operators weren't able to sustain those higher mortgage payments. And we had a slew, they're still having them, of capital calls and foreclosures, and it was awful. Like awful. So this is really important, the type of debt you're having. I don't have a problem with short-term debt. I bought something in April with a 2-year term. It's fixed though for those 2 years, but when I bought it, my interest rate was 9.5%, and I was confident that rates weren't going to go higher than that. Who knows? But I still stand by it's going to be okay. But that said, in 2020, 2021, 2022, when there were rumblings that the Fed was going to start hiking rates, a lot of people didn't think that it would turn out like this. So the type of debt anytime you're investing is really important. And then emotional decision making. I'm going to share this with you because I've done all of these. So I don't want anyone to feel bad about it. But I do want to tell you that I've learned my lesson, and I'm hoping to impart that here today for any of you. Not raising rents when you have a rental and just leaving it, or not charging a late fee so that your residents, your tenants start to just kind of maybe take advantage of you a bit. You know, I have an example. I didn't raise rent on someone for years. They're paying $2,600 a month, and when they moved out, I decided to go to a local agent and said, you know, what can I get for this? He said, oh, $3,200. I said, $3,200? I've been undercharging by $600 a month for years? I mean, I left so much money on the table. So not raising rents because I like the person, you know, it's not good. You know, real estate is a business, so it's important to keep your head on straight and remember that. And then holding a property that doesn't make sense. We'll go into that. Either it's losing money, or you have so much equity, the money could be working way harder for you somewhere else. So we'll look at that. Self-managing or lack of delegation. You know, a lot of people try to do everything themselves. And you know, Airbnb, I understand there's some tax advantages to doing everything yourself. There's that, you know, there's a loophole for Airbnb. But generally speaking, trying to do everything yourself is not, you know, it can be a mistake. And there's an example of that for me. For my rentals, first I said, I'm going to do everything myself. I don't need any backup contacts. It's just me. They can call me. Well, I was giving birth on a Tuesday afternoon to my daughter and didn't look at my phone for the day, obviously. And then I wound up in the recovery room, glanced at my phone hours after giving birth, and I had about 20 missed calls from my tenant. And he had a backup, a pipe backed up, flooded the whole thing, and he had been calling me because he had no backup. And we took care of it, but it was one of those, I apologized. I said, I am so sorry, I was having a baby. Because I never heard that excuse, but I really was. I was like, took a picture, it was wild. So this is something just, you know, having backups, you know, don't be so emotional. Like, I can control all of this, because a lot of women, we, you know, generally do these things. So it's wild. And then the other thing is getting emotional about your purchase. You know, a lot of people do this with single family rentals. Oh, I love this. I would live here. Yeah, but I mean, you know, it's easier to be less emotional about multifamily. Like, you know, that's all based on the numbers. But with single family, I've seen many people say, well, but the atrium's so cute. Yeah, but do the numbers work? And so, will you get more income from that atrium, or is it just going to cost you $400 a month to maintain the atrium? Like, you know, so we got to remove the emotions. And then pitfall number 4, which I'm going to give you my exact example from something that I held on to for way too long. You know, can your equity be working harder for you? I held on to this property way too long because I was convinced someday my daughters might want to live in it. They're 6 and 7 years old, okay? And the numbers, and I'll show you, I mean, the numbers it was a joke. I mean, I don't know if they'll want to live there, but it's gone, so they can't. So it's ridiculous. But the condo itself, I was cash flowing $500 a month. The value was $625,000. The balance at the time was about $325,000. So I had about $300,000 in equity sitting there. So if we do the math, $6,000 a year divided by $300,000 is 2%. So I was earning 2% equity, 2% on my equity that was sitting there. So finally I decided my daughters aren't going to be able to live there when they're 20 or 25, and I sold it. And I sold it, deployed the $300,000 into a multifamily property that's now paying me 10% cash on cash return. So I increased my cash flow from $6,000 a year to $30,000 a year by just selling the condo, removing the emotions, but I held on to it a long time. You know, I guess that goes back to pitfall number 3. But I think that you guys get the theme of the story here. So the next thing I'm going to do is just share with you a deal that my team did. And I want to show what can go right, because I know I just showed you all the things that could go wrong. But I think that as I explain how, I'm going to do a case study on Main Street Apartments, which was an apartment building that we have in Kansas City. What I want to show you is the decisions we made along the way that made it good. And so I just showed you and how we avoided a lot of pitfalls because of the decisions that we decided to make. So Main Street Apartments. So the big thing to think about when you're thinking about real estate, guys, is there's 3 pillars that you need to stand on. There's buy right. You need to buy at the right price. If you overpay, it's really hard to get out of that, to get around it. You need to finance it right, as we talked about or just a second ago. If you get the wrong debt on there, even if it's a good property, you're going to get into trouble. And then manage it right. It's probably the most important thing. You've got to be able to execute the business plan. Whatever the business plan is, you need to be able to implement it. So that's really important. And even if you have no interest in buying a 64-unit apartment building like this, all these rules that I'm talking about apply to a 4-plex or Erica's 3-plex. So don't check out because I'm not going to buy anything that big. Please just keep an eye on all the little things that we talk about, because any size property you buy, this can be relevant. So number 1, buy right. We acquired it in April 2021. It's built in 2004. I like newer builds. You're not really going to get that here. But I like the 2004 newer build products because you're going to have fewer problems with it. A lot of these 1960s, 1970s properties, you're going to have more problems. What I have with plumbing, electrical, things like that, foundation issues. We purchased it for $4.4 million. This is not in New York. You'd be shocked. No, this is in Kansas. And it was at $68,000 a door. I like this because that's less than replacement cost. Anytime I can buy a property at less than replacement cost, that means I'm getting the land for free. And you know that this property to be rebuilt would cost about $180,000 a door. So this was a significant discount. We knew we were buying at a discount. We knew we had to put CapEx, we had to put money into it, but it was still, the numbers still really shook out nicely. They're all 3-bedroom, 2 baths. There's generally a nice demand for 3 2s. You buy a building full of studios, they're generally harder to rent them out. So we like the 3-bedroom, 2 bath. Lots of different types of tenants can live in that type of property. And then every unit had its own meter. So all of their consumption, their utility consumption, was individually metered to their unit. So we didn't have to chase after people or bill back people for electrical and things like that. So we liked that about it as well. So the strategy was value add. We were going to buy it, renovate it, bring the units to market, and that's what we did. So we rebranded. It's in a college town, but there was a lot of young families there. So we rebranded. You could see it was called College Town. So we rebranded to Main Street Apartments, and we were able to successfully bring in a lot of young families and just a different tenant base. Students are great. Student housing is great, but they move out almost every year. And so you're turning units constantly. So we wanted less of that. They also move out around the same time every year, and that stinks too. So we wanted a more diverse tenant population, which we got. And then you could see over here, just basic renovations. We knew we could charge more if we just nicely renovated. Number 2 is finance right? So we bought it in June 2021. Purchase price, again, $4.4 million. Interest rate was 4%. We got a 5-year fixed rate. So that's what a lot of people who were buying properties of the size at the time weren't doing. They were getting 2-year variable debt with the assumption that they'd be able to refinance. And so that's what we did. We got a 5-year fixed rate term, 18 months of interest only. So we only made the interest only payments in the first period. So number 3, manage right. This is where things started to go south. We now self-manage our entire portfolio, but at the time we did not. And so we got a third-party property manager. And 6 weeks in, we knew there were problems. They were overspending on the unit turns. They're renovating, and the costs were way higher than they needed to be. All the costs were higher than they needed to be. We could quickly tell we were being taken advantage of. We were being billed for all sorts of things we knew we shouldn't be. The student lease-up was slow, despite the fact that it was June. It was prime lease-up season at the time, and there were nothing but excuses from the management company. And I said, okay, well, again, manage right. Things were going downhill. Then our expenses were high. Income was not coming in the way it should, so we were losing money very quickly. So we took over. And we took over the management. And that was one of the first properties that we just decided to self-manage on our own. We quickly turned it around. And within 6 months, the values went, or the net operating income minus expenses, for those that don't know, the net operating income went way up and way more to where we projected. So the net operating income when we bought it was $20,283. And then we got it a year later to $37,838. So if you can see that, the net operating income from June to June increased by $210,000. So I'm going to show you a little bit of math for those of you that don't know. But this is how we value apartment buildings. One of the reasons why I like them. You can't really do this in single family to the extent, but you can drive value of your property by increasing the net operating income. So this is the formula that we use. So the cap rate in the area is 6.7%. And the net operating income, the value that we created was $210,000. So within that 1 year period, we increased the value of our property by $3.1 million. That's, again, just applying the formula for the net operating income. And then we, like I said, in that year, we were able to increase it by $3.1 million. So that was a fantastic win. We knew we could achieve it as a self-managed operation. So we did. So what did we do? We didn't leave the money there. We took it out. We refinanced as quickly as possible. We quickly refinanced. We put a $5 million new loan on it. As you know, we bought it for $4.4 million first. So we put a new loan at the new value of $5 million. We put a 10-year fixed rate term loan on there. The interest rate at the time was 5.74%, 4 years of interest only. And so our debt obligations were as low as possible. And then we pulled the money out. So we returned $1.2 million to our investors, so 52% return of capital. We returned the money to them, plus we paid 8% distributions throughout the whole period from June 2021 even to today. We haven't sold this yet, but we will. So as an example of what we were able to get done for us, for this team, if someone invested $100,000 on this, they got $666 a month for that first year. We returned $52,000 to them in July 2022, and then they got $320, which is 8% of $48,000, the net, and they get that today. And we're looking at, we've got a lot of interest in this property. Actually, we're probably going to sell it within the next 6 months or so. So it was a really nice win, but as we tell the story, I wanted to show the stories because it was all about the management. We financed right and we bought it right, but if we hadn't replaced our manager as quickly as we had, it would have gone kaput. So again, this matters whether you're buying 4 units or 3 units or 64 or beyond. So it's really, really important that as you think about where you want to be in real estate, like what is it that you want to do? Because every single person in this room is going to have a different strategy, things that are interesting to them. Just think about, okay, who's going to manage the business plan? Because, yes, Sean. Yeah.
How do you vet manager?
Yeah, that's probably its own talk, but yeah, no, yeah, no, it's a really good question. I mean, I look at track record. I want to know what they've done, what have they exited out of, what's like what they call full cycle performance. I want to see what have they done. I want to see some gray hairs on the team. Frankly, I think it's kind of scary what I've seen. You know, a 25-year-old who just got their master's degree. No, and raising. I'm telling you, it's $30 million, and then losing it all. For me, those are the kinds of things I like to see. You want to know who's managing. Are they self-managing, or are they farming it out to a third party, which is what I just described to you. So that who's managing the business plan, if it's not the operator directly, like who's doing that. And I'm going to share this because I thought this was funny. When I first started investing passively, I met with someone who'd invested in about 30 different passive real estate deals. I respect him a lot. I sat down with him and I said, I just need to know what I should be looking for. And he said, he's a very sophisticated investor. And what he said to me was, I actually want to know that the operator has kids. I was like, what? I was expecting him to lay out his spreadsheets, and I said, why? And he said, I just need to know they have something to lose. And they can't disappear on me. I was like, wow. I'm sharing that because I was dumbfounded, and honestly, it's been interesting as I've gone through this space. I think about him a lot when I'm talking about these things, or when I'm vetting. But anyways, that said, does that answer your question? Track record, who's managing the deal, and yeah, is the primary thing. Yeah.
Can you talk a little bit about what makes a good deal for refinancing? Like you had 5 years, then you upped it to 10, not knowing if you're going to sell as quickly, like it's within 3 years basically.
Yeah.
And then the rate changed too.
Yeah. I mean, what you want to, in terms of when to refinance, like when
did you realize, obviously knowing how much you're making,
yes.
When did you think it was, like why not stay on that 5-year deal? You would have been within your 5-year period if you sold in the next 6 months.
No, that's a great question. We didn't want to leave the $3 million in the deal.
Okay.
We knew we'd created enough value and we wanted to return capital to investors. But that's a great question, because some operators may want to leave it in the deal and just keep their debt basis low and just feel a little safer about that. The time we felt like it was safe enough to refi, because we could still get a 5.74% interest rate and the property could very comfortably bear it, and we could return capital so our investors could redeploy into new assets. So they could still get their cash flow, but they could redeploy. So I don't like, as I've just expressed earlier, keeping too much money in the deal. I'd rather return it and have people redeploy it. Yeah.
Maybe a stupid question, but when you talk about self-managing, like, obviously you did not move to Kansas City. Like, do you have people on your team
Yes.
that you, like, literally sent to Kansas City?
Yes,
Okay.
yeah. Well, I mean, I didn't send them; they live there, and we connect with them, and yeah. But yes, no, that's a good question, because that was a big thing that I wasn't going to move. You know, my family's there. Even when I decided to start investing in real estate, I knew I wasn't going to do it in California. So that was a big piece of it, right? Like, I'm not moving, so how can I find the right teams? And I happened to find a team. I invested, Sharpline Equity, which is the company I work for now, I actually invested with them a lot on my own, well before I joined the team. So I got to know them as a limited partner, and then I joined them. But yes, and then now there's 1,000 units, so we have the scale. But it took time, yeah. Okay, what, go?
That was actually my question.
Oh, okay. Yeah, that's a lot of people. I mean, when I started, I literally flew around. And I flew to Nashville, and like south of Nashville, the numbers were looking good. And I met with, someone referred me to an agent, and then I got connected to a property manager. And so I really did a lot of flying around to start, because I really thought I was going to do it all on my own. I really thought I was going to do it on my own. I was like, I don't need anyone. And then as I started to get into it and realize the numbers that are really exciting are in these bigger deals, and I knew I wasn't going to do them by myself. So I knew I needed to get a team together, yeah, or join one, which is what I ended up doing. Yeah.
How did you find this deal?
This one actually came from a partner of ours who lived locally, and was networking with local agents.
Okay.
And that was, it's funny, it's a really good question, because I asked, when I started flying around on my own, I felt that the moment an agent in Kansas found out that someone from Los Angeles is here to buy real estate, the price went up. I mean, I tell you guys, they think everyone in LA and New York, or California, New York, swims in money. Like, it was hysterical. I mean, I felt like I wasn't getting the good deals. All the agents, we literally had an agent tell our partner, well, I'll sell to you because I don't want to sell to anyone in California or New York. Little did they know all the money was coming from California and New York, but like he didn't know that that our partner had investors. So having someone on the ground, local, who's connected to the community and knows the agents and can get those off-market opportunities is really where the juice is.
So you already know back then that you want to invest in Kansas area, or you have a couple areas that you look for?
A couple areas, yeah. I've got property in Tennessee as well,
Okay.
and Florida, but Florida's rough, everyone.
And then you mentioned about this term called replacement cost, right? Because this property, I think average is like over $60,000 per unit.
Yes.
But you say the review is about over 100,000.
Oh yeah, like 180,
So
yeah.
is that like one of your major number to underwrite whenever you underwrite a deal?
I do like to see buying properties at less than replacement cost.
Yeah.
Meaning, again, you're getting the land for free, and most of the value is in the build. I do like seeing that. Yeah, I think there's some protection there.
How much you invest in each unit when you upgrade it? Because I see the kitchen was like pretty outdated, and then you change to the redone the kitchen and everything.
Yes.
How much was the average cost on that?
Okay, we have to remember too, Kansas is cheaper than New York, so that upgrade costs about $8,000. Yeah, I know.
How long it take you for? Is that like 100%?
Yeah, I know. I shared that with one of our investors. She said, "You mean just for the paint, right?" I said, "No, the whole thing." She said, "Well, she lives here." Yeah. So, but yes, that was for the bathroom and the kitchen.
Wow.
Yeah. But we also have scale. We're buying everything in bulk. So.
Is that did you do the whole entire 64 units or just a couple of them?
Most of them, and that really varies. It's a good question because it depends on what the plan is. If we're going to hold it long term, We may do a longer renovation. If we have a shorter term hold, we want to leave a little what they call meat on the bone for the next buyer. So we might do 70% of them and leave the remaining 30 for them to do.
How long it take you for the whole project upgrade?
Well, so we're still in it. We're still in it. Yeah, we still own it, and like I said, we're going to sell it in about 6 months. So the whole period is exactly it's going to be about 4 years, 4.5 years.
The upgrade for the units.
Oh, the upgrades. We did them as they kind of came. So I would say a third is what we've kind of done each year. That's because some of the units we were able to maybe do a smaller renovation and still get those higher rents. So we're constantly gauging the market.
Are you wait for the lease is up and then before the new tenant move in and you do that, or you do that while they're still there?
No, we wait.
Okay.
And in certain situations, if tenants are a problem, we'll non-renew them.
Right.
And so the property we bought in April we inherited some residents who were paying $650 a month for a 3-bedroom when the market rent was $1,500. So we let them live there for a while, but at some point when we're done with the rest of the renovations, we're like, you guys, you either have to pay what market bears or we have to ask you to leave. So, and that's what we say, ask you to leave. It's just a non-renewal of the lease. Yeah, yeah. But no, we're never try to renovate while the resident's in there. That would be a pain in the butt.
Answer the questions because I know if you are now owner operator, a lot of people won't be able to answer those questions.
Yeah. Oh yeah. No. I'm on all of it. Yeah. We're talking about whether or not we should replace a stove in 1,500 units, and we're like, is that stove? I mean, we're very meticulous. But I mean, I think you need to be when you're operating properties like this.
For the loan, for the debt.
Mm-hmm.
So when everybody else is doing 24 months, but you guys were able to do a full year with the first 18 months interest only.
Yes.
Is that because you have a KP on the team? So
Yes.
Okay.
Yes.
Because otherwise you won't get the good return like that.
Yes, and for if you don't know, a KP is a key principal. So when you're taking out a loan for $5 million, and the bank wants to see that there's someone on the team that can be responsible for the loan if the loan doesn't get paid. So they call it a KP. So it's actually a great deal for the KP because generally they come in, if they sign on a loan with an operator they know is great, they get a piece of the equity just for signing on the loan. They usually do have to put in a little bit of capital as well, but not nearly close to what they're getting as far as a piece of the GP. So yes, we always have KPs on all of our deals.
Awesome.
Yeah. Any other questions?
Isn't 8% monthly return the kind of the average that you're seeing in the market for these types of deals?
Cash on cash.
Yeah.
So at exit, everyone's going to expect at least 15% annual IRR. But in terms of cash on cash, that's what we're seeing. Yeah, 7 to 8%. I was just a private equity meeting and from a big PE firm, and that's what they're paying too. So I said, okay, it's generally what we're delivering for our investors. Yeah.
I mean, I think if the stock markets do go in the direction or the growth that Goldman Sachs has predicted, that's going to become even more appealing, and perhaps there's an opportunity to.
Exactly, Hannah. Yeah. That's what we're seeing people already kind of notice that. Yeah.
Because I think there's been a bit of overconfidence, perhaps, on the investor side recently. It's like, why would I take that if I can get 7% in the equity market?
Exactly. Yeah. So it's going to be an interesting ride. Yeah. We'll see what happens. Any other questions on this? Just one more. But so I think the moral of the story here, and just what I want everyone in this room to think about as you're sitting here, how involved do you want to be as an operator? I have invested passively with an operator that was not full time, and we did okay. But I know that we could have done a lot better had he been fully focused on executing the business plan. So I think, there's ways to get involved in real estate. Large commercial real estate is not a side gig. If someone comes to you and says, "Oh, invest in my deal," I'm actually a doctor, but I'm running this 100 unit as well. My husband's a doctor. Nothing against doctors, but come on, you can't. It's not a side gig. So that said, if you want to be active and buy. Small multifamily single, maybe you want to create a joint venture with someone who's boots on the ground in wherever you're investing, let's say Greenville, South Carolina. If you want to do that, you can do that too. But if you're going to be, you just have to think about the kind of investor you want to be. Do you want to be active? Do you have time to be active? Do you have time to squeeze every last drop out of your whatever real estate you're buying? And if you're not, then think about doing it passively. I mean, I started my, as I mentioned, my real estate journey buying 3 single family and investing in 3 passive deals, and then just comparing which I liked, which felt like mostly like me. So if you're going to invest passively, I gotta educate yourself, and that's why you're here, right? You just want to know what you're looking at. So that was everything. Oh yeah.
Sorry, can you just expand a little bit about how you look at markets? I know you mentioned that like Florida's really difficult. Like, is that just recent, the trends, or can you just share a little bit high level how you approach that?
Yes, yeah. So Florida's gotten difficult the last several years. My insurance has gone up 150% in the past 2 years. Yeah, so insurance has been really tough. Property taxes have gone up as well. So, and you're dealing with a lot of oversupply. So generally, when I'm looking at markets, I want to see population growth, which Florida has. I want to see job growth. I want to see that it's business friendly, because then it will generally be landlord friendly. And and this is not to be mean. If you stop paying, you have to leave, and it shouldn't take me a year to get you out. Like that's just how. So I really look closely at that. Yeah, like New York, LA is the same way. My friend, it took her 2 years to get someone out of her townhome in LA. So whereas in Kansas, if you're 7 days late, we can put a notice, and then usually they leave because they know they're not going to win, and they don't want to get stuck with an eviction attorney bill. So that's really important as well.
How's Florida with that?
Florida's great. Florida's great with that. Yeah, they're not bad with that. The natural disasters in Florida is what kills me. My cash flow has just been crunched. I mean, I just paid it a hurricane deductible because my roof blew off in Milton, and so it's just that's what makes it more difficult. But in terms of landlord friendly, yeah, it's a more transient population, so the tenant base, I mean, I'm generalizing about a state, right? But the tenant base tends to be nice. The income, the rental rates tend to be a little higher as compared to the property value. So that's what attracted me to the state. But I'm not buying more there because of just the expenses have exploded. So, yeah. But does that answer your question?
Yes, thank you very much.
Yeah. And if you're just starting and you say, no, I want to do this all by myself, I tell everyone, I think I told you the first time I talked to you, Kelly, was that if you have someone who you care about who lives in a place that is a good rental market, I would say go there. Like if you've got someone in Indianapolis who's a great friend of yours and it's a great market for rentals, then you get to write off your trips to go visit them, and then you can start building your rental portfolio in Indianapolis. You know, if it's something that you want to do on your own. That's why I started with Tennessee when I first started, was because I have a great friend in Nashville and I love being with her, and so I said, okay, I'm going to fly out there, I got a place to stay, and then I'm going to drive all around and find some properties. So that's, a way to start if you want to be active. Any other questions? Yeah.
Sorry. So with some of your properties, you're mentioning that you invest passively, probably, as an LP, but then you also own properties outright individually between you and your husband. Like, how do you think about your portfolio diversification between those different real estate assets, and are you constantly shifting things, or do you certainly see like low risk here, high risk here, passive here, active here?
Yeah, I'm very focused on, at this point in my life, I'm very focused on velocity of money. So when I'm investing in like that Main Street apartment, I like it because I can expected a refinance, I can get the capital back and redeploy it. So at this point in my life, that's what I'm focused on. If I was 70 and I wanted to take it a little easier, I might invest in some triple net leases that will just pay me consistent income. Do you know what a triple net lease is? Like a big Walmart? Yeah. So I'd probably do that. But at this point, I can recover if things go wrong. So I'd rather just see my money move as quickly as possible. So that's where I'm at. But as I said, this is where the education comes in, because everyone has something different. Whatever you feel. I know someone who owns 30 single-family homes, and he loves it. He gets $200 a month from each one, and he's just going to pay him off until he's, retired. I'm like, great. To each his own. This is what I honestly think. This is what's fun about real estate too. You can really figure out what suits you. Yeah.
I'm just wondering. So, your husband's a doctor, and you have a full-time job as well. So, I'm just wondering, why do you guys keep your other full-time jobs, and why don't you guys just like live off the rental or your real estate income?
Well,
what your reasons for that?
Well, it's not enough. My passive income is not enough to pay for our whole expenses at this point. So that's a piece of it too. But the other thing is we're really focused, as I mentioned, on velocity deals. So for example, the one that I told you about my condo, the $300,000, we put it into a deal that we're renovating, but I'm not going to see $1 of income from that deal for at least a year and a half. And we have a lot of those. So it's going to be great because I'll be able to refinance and get my money and redeploy it. And over time, I will build my passive income that way. But a lot of what I'm invested in right now is that high velocity, not necessarily income today. I'll see it nicely in a few years, but just kind of moving the money, because that's a strategy of ours. I also love this, and I'm going to do it till I die. So that's also different. I met an 87-year-old who's still doing real estate deals, and she's been doing them for like 45 years, right? And it just inspired me, but she loves it, and she's, so I think that it also depends on the life that you want. My husband will not be in the emergency room till he dies, so it's like he's going to be, we'll navigate that way, but. At this point, the passive because of the deals we've chosen to get into, the passive income isn't large enough to support our lifestyle.
Wait,
Yeah.
so how do you structure this deal as a GP? How you get paid as GP for that deal?
GPs? Yeah. Well, it varies. So every deal I get, I'm also a limited partner, so I get passive income from that. So that 8% also comes to me. Okay. And then general partners, it varies. Tends to be an asset management fee as well. Yeah. So usually it's a point or 1.5%. Of gross as the fee to manage and do all the management. Okay. But the vast majority, and this isn't always the case, but it is the case for us, the vast majority of compensation comes on the exit. And that's what I like. And another thing, if you're going to invest passively, you want the majority of the compensation to come from the performance of the property. Like, do well, and then you can get paid. But I hate when I see a lot of front loading of fees, because I think it's really important to execute before you see any big paychecks.
Yeah, you investor like that structure too, right? Because they are going to get paid and.
Yeah. I think that it provides confidence to anytime you send a term sheet to a potential investor and they see, okay, you might get a little bit, you're going to get a little bit up front, of course, but the majority is going to come when you do great. Yeah. That should give anyone confidence. Yeah.
And then they're more likely to invest with you again. So.
Yeah, and that's exactly right, Hannah. It's it really is the majority of the people that have invested with us have done it for deal after deal after deal, because it's just like a trust thing. Yeah. So I absolutely love, I put my calendar on here. If you want to schedule 15 minutes with me, if you're not sure what your strategy is, as Junko knows, I love to help people strategize like the next step for them in real estate. So please feel free to reach out to me, schedule time with me. I did put my yes. And again, 15 minutes, I can help direct you depending on what it is that you want to do. I can introduce you to the right people, and please, connect.
Thank you.
Okay? Yeah.
Okay, so I don't probably need this, but back by popular demand, get excited. We are gonna do hot seats, which means, and I would love the speakers to be involved too. So you might get a speaker in your group, but we're gonna break up into groups of 4, and then I would love, it's an invitation, for you to each kind of tell where you are in your real estate journey and get some feedback. So we're going to count off in 7s. I think I'm decent at math. That should be 4 people and then 2 extra people. So then we'll break out into groups of 4s. Each person can go for like 6-7 minutes. I'll call the time. Just kind of say like where you are in real estate and where you want to go. And within that time frame, sometimes people have feedback for you. If you have any questions, that's also a time to bring it up. So I'll start. We'll just count in 7. So 1, 2, 3. Now I can see if you're paying attention.
5, 6, 7, 8.
1.
Oh,
1, 2,
3, 4.
Remember your numbers, guys. 5.
6, 7, 1.